Are you looking for the next 10 bagger stock? Let me tell you, it is in the small cap funds and it is present in the markets today. I will give it to you, one of those stocks in this video today, and I will give you the reasons why I think that stock will 10x in the next coming 4 to 5 years. Everybody is running away from small caps and they are running into high flying FANG stocks, large cap stocks, which has left the small cap sector ripe with pickings for a value investor, a person who is looking for cheap deals to buy that can 5x, 10x in the future for him. And large cap stocks just don't provide that opportunity anymore because their P by E ratios are so high, their prices are so high because there is so much money, there is so much liquidity in the markets, and all that money is flowing to the large cap stocks, which has pushed their prices to a sky high price. While the large cap stocks are trading at P by E ratios about 25, the small cap stocks are trading at P by E ratios below 15 or somewhere around 15. So that leaves it very, very ripe, and that makes a lot of opportunities for value investors or people like you and me who are looking for deals to go hunting in the small cap land, because that is where exceptions are existing and they are there if you look for them. And that is what I found, and that is what I'm going to share with you in this video. So I will give you the 10x stock. I will tell you my reasons why I purchased it, why I added it to my portfolio. As you guys know, I'm very picky with my purchases. I rarely ever buy a new company. When I buy it, I make sure that I read the 10Ks, the 10Qs for the past 5 years. I read the future industry growth and all that kind of data that I will give it to you in this video. And I really do a deep research when I add something to my portfolio. And I've added this stock to my portfolio after 2-3 months of due diligence. So I'm going to break it down piece by piece for you guys in this video and why I think this will be the next 10x stock. Also, towards the end of the video, I will also give you guys a quick update, a quick look at my portfolio. So with that said, let's get right into it. So as I mentioned, the P by E of large caps is at an all-time high at 20.3 right now as of today. So that makes it very hard to find deals, to find cheap opportunities in the large cap land. And Ben Graham and Warren Buffett says it's the price that you buy that matters. You make the money when you make the buy. When you buy it at a good price, that's when you make the money. If you buy it at an expensive price, you're risking too much. There's too much risk. But if you buy it at a cheap price, the risk is low. So right now, S&P 500 large caps or all the large cap stocks, they are overpriced, except something like Facebook, which is underpriced right now as compared to its competitors because of the negative news surrounding it, which makes it a great time to buy companies like Facebook, because in the future, we know from our analysis, and if you do like future price earnings per share, based on that you count the price should be well above $400, but it's somewhere around $300 right now, $320. So it's a very great buy. But other than that, there are hardly any deals in the large cap land. Everything is about 25 or 30 P by E ratios. Companies like Microsoft, Apple, and Google and Facebook, these companies, they're trading at sky high P by E ratios. So that forces our hand to get into the land of the small caps, which are being ignored. Nobody's looking at them. I mean, not a lot of retail investors are looking at them. The value investors are still hunting for deals down there, but not a lot of retail investors are taking a look at the small cap, which makes it ripe for pickings, which gives us great opportunities. And that is where I found this 10x stock. Now, since the P by E of large caps is so high that it has been only time it has been this high has been below before any recession or before any depression, like in 2008 and 2020 and 2002 and 1, when during the tech bubble, and also during the times of 1930s. The only time it has been this high has been during those periods. Does that mean that we are due for a crash? Does that mean that we're going to have a large bear market, like 20 years, 10 years, a stinky bear market? Or does that mean that we will enter into a depression? Well, nobody knows for certain. And if anybody claims they know, then run away from that person in the opposite direction. Because nobody can tell what's going to happen in the future in the markets. They can go sideways, they can go upside down. Nobody knows the future in the markets. Based on that, what can we do is we can buy great businesses at great prices and just hold on to them. As long as the fundamentals are good, as long as the bottom line, the story stays the same, we will be fine because we are the owners of great businesses. And so that is why buying great businesses at cheap prices becomes crucial for any investor who wants to make money in the markets, who wants to make money no matter what market it is, a bear market or a bull market. If you want to make money in such markets, it's good to buy great businesses at great prices. And that is how you survive no matter what market it is. Now, I have been buying a lot of Facebook recently, and this video is not about Facebook, so we will not talk a lot about that. We will move right on to the small cap stock that we will be talking about. But I've been buying a lot of Facebook in my stock portfolio, because my stock portfolio currently it's still major large cap stocks. I don't have a lot of small caps other than this one, the one that I'm going to talk about. Other than this, I don't have many large caps. I don't have many small cap stocks in my portfolio. So I have been buying a lot of Facebook this past month, and I will also give you an update towards the end of the video. Facebook is a great buy right now if somebody's looking to add a large cap value company to their portfolio. Facebook, it's a great buy. The P by E ratio is historically very low, and the future earnings, and based on the future projections, and based on where the company is right now, their market cap, and their reach among customers with so many daily, almost 3 billion daily active users. So this is a great company to buy. I mean, it's just a fabulous business. Now let's talk about the 10x stock, the stock that will 10x in the next 4 years, 5 years. And that stock, my friends, is Medifast. Medifast, ticker symbol MED. The stock is currently trading at $194.78. Now, this is a small cap. The market cap is only $2.2 billion. Okay, and the dividend yield is 2.94%. And the P by E ratio, the forward P by E ratio, is only 13.87. Okay, so this is a dividend paying stock that has a market cap of $2.2 billion, and that has a P by E ratio of 13.87. So this is very cheap compared to the markets today. Even the average P by E ratio for small caps is 15, and this is trading at a forward P by E of 13.87. So that can give you some idea that okay, yeah, this stock is really cheap. Over the past 10 years, the stock is up by almost 1000%. Okay, over the past 5 years, the stock is up by almost 385%. Over the past 1 year, the stock is up by almost 21%. Okay, so that is how the stock has performed, the market cap, the dividend rate, the P by E ratio, the forward P by E ratio. Now this company, Medifast, they have a product called Optiva. Optiva is a health product. So basically, they help you reduce weight. They give you a diet plan. They give you coaching along with coaches that guide you along with the journey. They have almost 44,000 coaches, and along with the diet plan, along with the guidance of the coaches, they help you reduce obesity. They help you reduce weight. They help you get back in shape. So that is what their central business is. Their product is Optavia, and Optavia is the product that they're selling. It's a line of food products. It's a line of basically a lot of products that help you reduce weight. So that is their central core business. They have almost 44,000 coaches. Now these coaches, they were their students, they were basically their customers before, but they got so inspired by this product, by the results of this product, by the results of this program, that they eventually decided to become coaches and dedicate their life towards helping other people get back in shape, helping other people reduce weight, helping other people get back from obesity, and get safe from diseases and all that kind of stuff. So these 44,000 coaches that they have, they are basically like a multi-level marketing company. I know that's a negative term in the United States, but it is actually a fabulous business model, because word of mouth is the strongest marketing strategy ever created, and it travels faster than anything else. So word of mouth is their main marketing strategy. They are a multi-level marketing company. They have 44,000 coaches, which hire more coaches, or which train more customers, which then get inspired, and then they become coaches, which increases the cycle, which increases the web bigger and bigger and bigger. And through those coaches, they push those products. Now those coaches, they are not employees. They are entrepreneurs. They are entrepreneurs who work alongside Optavia, who work alongside Medifast, and help people get back in shape, but through the means of the products or the meal plans sold by Medifast under the name of Optavia. So that is what their core business model is. That is what they do. Main market is United States, but this year they are entering in Singapore. They have entered in Hong Kong. They have some coaches in Hong Kong right now. So they are making entries in the Asian markets as well, which is one of the biggest markets in the world. The obesity industry in the United States is $97 billion. Okay, the meal plans, the food for people who are overweight and all that stuff, it's $97 billion in the United States, and it's growing faster than ever. During the pandemic, during this previous COVID-19 pandemic, it has grown faster than ever before because people are now staying at home and people are not able to go out and work out, and that's why people have gained a lot of weight. So now it has grown even faster, and now people don't want to go out, people want to stay at home. And this Optavia, this company Medifast, is placed in such a way, they have the coaches, okay? So the coaches, they will sit at home, they will help you, guide you through the program, and they will send the meals to your house, to your doorstep. You don't have to leave your house. So this is very well positioned in the for the future. People are don't like to go out of their houses. They come right, they help you, they deliver your meal plan right at your door. They have coaches that help you through Zoom and other means, through phone, to help you get your on your journey of reducing weight. So it is very well positioned to get a large market share of that $97 billion, which is ever growing faster than ever. And even in the Asian markets, it's growing faster than ever. And that's where they're also entering. So $2 billion market cap currently this company has. A market cap of $97 billion is out there to be taken. And this is one of the biggest players in the space. So there is a market out there to be taken. So that is why I am saying this stock can 10x, if not 20x or 30x, if they can make a big dent in the Asian markets, because they are one of the first players in those markets in Singapore and Hong Kong right now. They're fresh markets over there, and they are one of the first players to enter those markets in this industry with this business model, and they can make a huge dent over there as well. They have a huge market cap to take over in the United States and out of here as well. So that is why I am saying this stock has a 10x potential. And the way that it has been growing over the past 5 years, 10 years, if they continue doing that, they can even go 30x, 40x within the next 5 years, guys. And I'm not even kidding. They can grow like 30x, 40x within the next 5 years. That's how rapidly they have been growing over the past 10 years. And the result is in the pudding. The numbers, their revenues and everything show for that, and we're going to take a look at that right now. So if we look at their financials, let's look at the numbers. Okay, let's look at the top line. The top line has constantly been going up. Now it has fluctuated somewhere around, but they haven't gone down much. Okay, it has constantly been going up. It has almost doubled in 2020 from where it was in 2018, and almost tripled from where it was in 2017. So that shows that the top line is constantly growing, the company is constantly growing, the gross profit has been growing, okay, consistently, and the operating income has been going up. Okay, also if you look at the bottom line has been going up as well. It has almost gone double of what it was in 2018. In 2020 it's almost double of 2018. Okay, so the top bottom line has been constantly going up as well. It's supposed to be at $150 million for the year of 2021, which is almost like a 25% or 30% jump from where it is at right now, just in 1 year alone, guys. That's just 1 year. Okay, if we look at the diluted earnings per share, the diluted earnings per share as of this year is $8.68. If you multiply that by 15, okay, for the previous year, if you multiply that by 15, that gives us a number of, if we multiply that by 15, that gives us a price of $130. And that's not including the book value. So $130 should be the price of the stock based on a PEP by E of 15, based on the earnings in 2020. In 2021, they are expected to be at $12.67. Okay, the earnings per share expect to be $12.67. If we multiply that by a P by E of 15, that gives us a price of $180. $180 for the price of the stock. Currently it's trading at 194, and that is excluding the book value. If we add the book value, which we will see in a bit, we will add that and then we will come up with the price, then the price will go even higher. So the price that it's trading at right now, $194, I think it's very well justified. Once we add the book value, you will see that. And they're expected 2021 $12.67 earning per share. In 2022, it is expected to be well over $16. $16 earnings per share. If you multiply that by 15 and then you add their book value, the stock price comes out to be somewhere around $250 to $265 just in 2022 and 2023. So that is right there. You get a 25 to 30% return on your money if you buy this stock. Okay, if you buy this business, that is a 25 to 30% return on their money on your money if you buy this business, because the company is expected to grow their bottom line, their net earnings, their earnings per share by almost 25 to 30% next year and the year after that. So that is a easy return on your money, and that's why I'm saying the way they have been growing, if they can continue that for the next 5 years or 4 years, this stock is a 20x, 30x stock, man. This is a 20 bagger easily. Easily, you can see it right here within their earnings per share. Okay, it's constantly been going up. Okay, and it's not going up by small amounts. It's going up by 20%, 25% within the past 4 years, 5 years. Okay, also the number of shares outstanding, they have been reducing the number of shares outstanding. It went from 13.8 million to 11.8 million in 2020, which is a very great sign. I don't think they have any preferred stock or any warrants out or anything like that through which they can issue common stocks at any time to pay their debt, which is a really great thing. But they have 11.8 million shares outstanding as compared to 13.8 million back 7 years ago. Okay, so that means they're buying back their own shares. The business is in a fabulous shape. Okay, they have so much cash on hand, they have so much excessive free cash flow that they're using that to buy back their own shares. Now, this is a great sign for any business and in a great position for any business to be in, to pay a stable dividend and to buy back their own shares. They are also paying dividends, which we will look at. They're buying back their own shares. The earnings are increasing by almost 25 to 30% every year. Stock is trading so cheap at such a low P by E ratio. Okay, and it's growing rapidly. It's a solid business with 44,000 highly motivated people that have used their products themselves and decided to become coaches, with word of mouth being the strongest form of marketing that's being used to market their product, which has shown results. I don't see why this stock will not 20x or 30x in the next 4 to 5 years. And how I hope how I'm explaining, you guys can see that too. Okay. Now let's move on to the real number, which is the book value. Okay, book value is very, very important. I look at the tangible book value, which is minus all the bull crap, the goodwill and all that blah blah bull crap, whichever the companies put in on their names, and they try to make their names, which is goodwill, a long number, and add the book value to that. So I'm taking all of that out. Tangible book value takes all of that out. It gives us a rough estimate of what you will get if the company starts liquidating everything tomorrow. If they go bankrupt and they have to liquidate everything, what you will get. So if this company goes boom bust and they have to liquidate everything, they will give you $13.41. Now I know this is very, very low. Okay, $13.40, that's a 2020 number, and right now it's $16.66. Okay, which is even higher than that. So I know $16 for a stock that you're paying $195 for is very low number. The asset value is very, very low. But the thing is, the price is based on earnings. This is not 1940 anymore. I mean, Ben Graham's formula worked in 1940, but in this market, you have to look at the brand name. You have to look at the business. Okay, if you go solely by the book value, you will not make any money because there are no deals out there that are selling only at book value other than oil and gas companies. So you have to look at the earnings, you have to look at the earnings per shares, and you have to look at the brand name, how strong it is, how resilient it is, how it has performed over the past. You have to look at the management, you have to look at everything. Okay, and based on that, based on the future, I know future is not a good place to look at to put money in, but that's how it's working right now, guys. That's how you're making money right now. There's no other way to do it. Go with the flow. Okay, so I'm using the future value, future earnings per share to come up with a price, multiplying that by 15 and then coming up with a price plus adding a number of 16, which gives me a price of $196. The stock is currently trading at $194. Still $2 cheaper than where it's supposed to be for 2020. Okay, for 2021. Okay, still $2 cheaper. This is a great deal to buy. This is a great stock to buy just by the earnings and the book value. This is a discount deal. Okay, in 2022, 2023, the earnings grow by the same number they have been growing, 25%, 30%, let's say 15%. Stock will be at $225. 194 to $225. Easy 20 to 15% return on your money just in 1 year. And it will be way more than that. I know it will be growing by 25 to 30%. So there you go, 25 to 30% return on your money instantly within 1 year. And within the next 4 or 5 years, sky's the limit, guys. Sky is the limit, I'm telling you. Now let's look at the dividend history. Dividend history is a very important metric because if the company has ever missed out on their dividend payments, that is not a good sign. That is a very bad sign for any business. So during the 2020 pandemic, not only did they increase their dividend, they have never missed out on paying a dividend over the past 5 years. Okay, the company has never missed a dividend payment in the past 5 years, and even during a pandemic, during a recession, they have increased their dividend. What does that tell us? That during pandemics, during recessions, during hard times, this business will survive, not only survive, but also prosper, because people always want to be healthy. People always want to lead a good life. People always want to do better. Okay, and this is one of the ways, a well proven way by 44,000 coaches who were their customers, a well proven way of help people improve their health, of help people get better, get back in shape, reduce the weight. Okay, so this is a well proven way that this business has done that in the history. Okay, they have never missed out a dividend payment, constantly been increasing their dividends. Not only you get that growth of 25 to 30% on your invested capital, but you also get that 2%, 2.3% dividend payment every quarter. Okay, what can be better than that? And it's always increasing. It's increasing every year. Okay, that is fabulous, guys. The cash on hand is 197 million. The debt, total debt, is 20.5 million. Okay, so they have more than enough money to not only run their operating expenses for 2 to 3 years, but also pay off their debt 8 to 9 times over, or even more than that actually. So they are in a very fabulous, very safe place. Mr. Peter Lynch says that, the companies that do not have much debt, they don't go bankrupt. Okay, so since, look at that, 20 million and 197 million in cash, 20 million in debt. There is no way they can go bankrupt because financially it's like a castle. They're in a very solid place. The other metric that I look at, some people might find it irrelevant, but I do look at it. The other metric that I look at is the institutional ownership. For Medifast, Octavia, the institutional ownership is 80%. Now, if it's above 60%, I generally don't like to buy it, but that is not one of the only reasons that will make me stop from buying a great business, okay? The institutional ownership is a little bit high, but it's not 99% or 100%. There is still very less amount of institutions that are running after this stock, which makes it even a great buy, because once the institutions start jumping in and pumping in money, the price will fly above the roof. Okay, when this number goes to 95% or 99%, I'm telling you, the stock will be at $225, even way more than that. The insider ownership is almost 4%, which is always a great sign. The more the insider ownership, the better it is, the better is the business. Market cap of 2.2 billion, dividend yield of 3, almost 3%. Okay, dividend of almost $5.68 per year. Okay, 25 to 30% increase in the earnings per share year over year, expected to be over for the next 5 years, 4 years, expanding into Asia, a huge market space to capture in the United States. Okay, I mean, the list is endless. However, there are some risks. Okay, there are some risks. Don't think there are no risks while buying this business. Okay, the first risk is, of course, FTC. FTC coming after multi-level marketing companies. Okay, they have been doing that over the past, I think, 15, 20 years. With Herbalife, they came after Herbalife. They came after multiple multi-level marketing companies. So there is a risk that FTC can come after this company, the government can come after them, and uh, fine them, or you know ban them or something like that outright. Something can happen. The governments are unpredictable. So there is a risk that the governments can come after that, the FTC can come after that. Something like that can happen. There is a risk that you know maybe their product in the future is not that good, maybe the management is not that good. These are, I mean, underlying risks with every business. I'm not downplaying the risks. The risks are there. The risks are with every business that you buy. I'm just mentioning it based on what I read in their 10Ks and the 10Qs for the past 5 years. These are the risks that they're mentioning over and over, so I thought it would be right to mention it to anybody who's listening. The positive side, they have a huge moat. They have a huge moat, okay? They have a huge moat with their 44,000 coaches that were their customers, that believe in their product, that know the product is good, that will do anything to succeed because they're so motivated by the results that they have seen themselves firsthand. That is the strongest moat that you can ask for any business. Stock that is available at a great price, great return on your money, pays out a stable dividend, never miss the dividend pay, and continuously increasing dividend payments. Okay, buying back their own shares. Management owns over 44 over 4% of the company. Okay, so this is a great business in my opinion. And that was my 2 cents. Let's do a quick update of my portfolio. So my portfolio value is currently $198,469. Currently, I'm up by almost 21%, gains of $27,000 within the past 11 months, 10 months or 11 months, something like that. So far, the gains are good, but there are some big losers in my portfolio, and the market has been going up and down, but I have been buying a lot. In the past month, tech sector is the biggest loser in my portfolio. I have added some new positions, which I will share in the next videos with you guys. Facebook is my biggest loser, but I'm buying more and more of Facebook among other companies that are also losing some money, but it's not a big deal. I'm not really worried about it. So I've been buying a lot of Facebook and all the companies that have gone down in price. Today I'm about almost $1,000, 0.54%, which is a good sign. I'm not really worried because I'm thinking long term. This is a long term hold portfolio. So yeah, that was a quick update on my portfolio, guys. On the value of the portfolio, almost close to the 200K mark, which will touch hopefully this week or next week. Find value in my content, please don't forget to like and subscribe. Leave me a comment down below. This is the Frugal Investor signing out.